Hello, everyone, and welcome to BFW 2401, Week 3, Loan Sales and Securitization. This is part 2. So we are talking about securitization in this part. It's around 24 slides. And just a few comments before I start. Now, securitization is just like loan sales. The difference is we need to change. In loan sales, we sell the loan as it is now, and it can be direct between the buyer and the seller. And securitization, we have to have somebody in the middle called special purpose vehicle or the trustee who will take all those loans, back them, and make them bonds, which means now you transfer the loans to make them bonds. And we know the characteristics of bonds. Bonds need to be we need to have a homogeneous type of loans that will have the same rate, which means all those loans inside this bond, backing this bond or backing this security, this is why we call it asset-backed securities, which means you have all those loans. Now, all those loans have to have the same maturity, have to have the same interest rate, and the same payments. So in this case, you will have to back all of them, and this is why the term homogeneous loans come to the picture, which means you have to take all those loans at least with the same maturity and the same return. So, in end of the day, they will come up with constant payments during the life of the bond. So in this case, you can sell a bond for 20 years or 30 years if you have loans inside for 20 years or 30 years. So for example, if you are taking housing loans, it's that maturity of you sell a loan or a security for 20 years. If you are backing, for example, car loans, you need to have all those loans that is 5 years or 9 years. So when you sell to the investor does not know, it has nothing to do with the loans. The special purpose vehicle is the one who will operate that one. So the special purpose vehicle, in order to back those loans, they need to be homogeneous. Then having said that, let me go down to share my slides and start. Okay, this is my slides. And we are talking about loan sales and securitization, part 2. And we can go to the introduction directly. And here we are saying that the asset securitization is the backing and selling of loans and other assets backed by securities. What are those securities? We mean the loans. Securitization was originally, this is just a historical perspective, used to enhance liquidity of the residual mortgage loan market. What does it mean? When we say enhance the liquidity, means if you have a loan that can be staying for the next 20 years, a housing loan, now I can, which is a very, very illiquid asset, now I can make it liquid. Liquid means I can liquidate it today. By selling this, by backing those loans in some type of security, and then the security can be sold and bought between the investors, which means they have this asset pricing issue. They know the future cash flow, and based on the movement of the interest rate, they keep, selling and buying as a very normal bond. Which means now, in this case, you actually transfer this bond, which was very liquid, and make investors interested in selling it and buying it in short-term basis. Now, another historical issue, more than 61% of the residential mortgages are securitized in the US as of year 2009. Securitization actually started in all those countries, especially after the year 2001. And, it takes its peak, as I explained before, by the financial crisis, which is 2008, 2009, and then getting slow, then going up. Okay, this is the whole concept, and this is one of the most important slides I want you to concentrate. I mean, to absorb. See, this is the bank. This is the bank who generated the loans. Say they have 500 loans of 1 million. This is 500 million now. This is what they give you as of today, for example. Now, in this case, they will build, of course, these loans, the problem with those loans is the credit risk. So they have to buy some type of derivatives to protect them against credit risk, which we call it credit insurance. And we have so many of them to provide you with this credit risk. We'll talk about it in the future. Now, this is insurance. They will pay a premium and insurance. Now, they create the loans. Now, the loans are, in terms of credit risk, is protected actually. They pass the loan to the special purpose vehicle. Now, somebody will say, what is the special purpose vehicle? Those are actually trusted. In Australia, they are very restricted about it. Who's going to be a special purpose vehicle, who is allowed to back loans and sell them as bonds. There is what we call Australian prudential standards governing securitization, and who is allowed to be there. Now, this can be created by huge banks, but they are independently, legally, structured according to the law. So it's not part of the bank, but actually independent business identity. Now, in this country, we have Kagamas. Kagamas is actually the party that is receiving all those loans and serve as a special purpose vehicle for all banks. Now, if you are from any other country, you should have some special purpose vehicle. If you are doing securitization, if your country is actually active and banks in your country active in securitization, there must be a special purpose vehicle. Even if they are formed by the banks themselves, for example, the bank will build a company with a special purpose vehicle, it has to be licensed to exercise these things. Now, these people will take loans. Remember, they are taking it, they take loans. They do their magic here. And they form all those loans and back them and make them securities. So they calculate now, they calculate the cash flows, and they understand now what is the payment, because they we will go and sell this pool of loans to some investors here, though in time zero. Now, the investors will give them the money and they want to know how much they will receive, what is the cash flow in the future, like when we pay coupons for a normal bond. So the payments actually, which is considered to be the payments, like the coupon, is the payment that is coming from the borrowers over the 20 years or 30 years, depends on the maturity of this security. Now, who is going to receive all those payments? The special purpose vehicle. And who's going to pass the coupons? The special purpose vehicle, to the investors, because those investors can be investor A, investor B, investor C, changing. But the special purpose vehicle still, the pocket here who receive all the money from the borrowers and give it as, first of all, they have to sell it today. When they sell it, the investors will bring the money here and they pass it to the bank. This is finished. So loans, backing them in time zero, selling to the investor will give the money now, they will pass the money to the bank. Of course, they will after they take their fees, and it's over. Now, later on, as I told you, as times during the life of this security, the money will come from the borrowers and to the special purpose vehicle, who will pass it to the investors, and the case is over. One more thing, what is the worst thing that could happen to the special purpose vehicle is when there is no payments, when some of them are defaulting, when they have liquidity problem. They need to pay the coupon completely to the investors. If the some of the borrowers didn't pay in time, then you have a problem of giving coupon, not complete coupon. So what they do here, they buy insurance, and this insurance called liquidity facility for the cash flow. So if there is a problem in the liquidity coming, these people already make insurance and pay premium. So this may credit, this may liquidity issue. So they ensure that the payments is actually enough to pay each coupon in time. Now, I have developed all this, which is the same thing. This is what to look at it, from. So as I told you, this is stage one, right? So this is the bank. They pass the special purpose vehicle. Special purpose vehicle pass it to the investors. This is step one, step two, step three. This is step three. And this is, I think this should be three. This should be three, typo. This is step four. This is step five. This is step six. So this is how the cycle is happening in time zero. It goes from the bank, special purpose vehicle, to the investor. So the loans come to here. Special purpose vehicle will back, give it to the investors. Investors will pay the money to go to the bank. The bank is over with it now. Now the problem now is among the special purpose vehicle and the investors or different investors. What would happen now after that? So after that, this is what will happen later on or during the life. So during the life, of the security, this is what's happening. See, which is, for example, for the next 20 years. So you have, this is borrower one, borrower two, borrower three, and you can just continue with more borrowers. So you can continue with more borrowers, and so you can have 5, 6, and continue. So just this is, for example, you just continue with those borrowers. Okay, now those borrowers actually will pay in each payments. For example, if I am scheduled to pay monthly basis from next month, third month. So if the security is 20 years and the payment is monthly, those people will pay how many payments? They will pay 240 payments, which means the investor will receive 240 coupons. Each payment from this guy, from this guy, from this guy. So we have here, I don't know, it could be 500, as I said before, if it is 500 loans, it will be 500 payments that will continue for 240 months. So in each month, there will be 500 payments going to the special purpose vehicle. Special purpose vehicle will take that money and give it to the investors as coupon. So this is the pool. This is the pool, which means, and this is actually the loans that backed the security, which is held by the investors now. So this is how the cycle works. So this is in time zero, and this is through the life. So this is, we can say, this is very important to understand how it works. So this is actually in time. When the security is issued. When the security is issued, this is what's happening here. Okay, and this is what's happening here. So this is the whole cycle, and I want you to be aware of it. So you can just conceptualize it and understand how is the process, because it will help us. Now, one more question. We remember when we talked about loan sales, what was the most important item in the negotiation between the buyer and the seller? And we calculate it according to our calculation later on, sorry. We were only interested on the price of the loan. Here, we are not interested in the price of the loan, which means the calculation here, we know the price, which is the pool. If you have 500 loans, you give it today, it's 500 million. The question is, when the investor will give you this 500 million, his question is, how much you will pay me in the future? So the question here is to calculate the payments. If you look, it's just a simple annuity formula. So in the annuity and in the loan sales, we are concerned about the present value, and here we are concerned about the payments. So this is two things I want you to be aware of. So now we have talked about the concept of securitization. We want to talk about the vehicles. Now we are talking about, we are bringing new terms to the discussion. What is a vehicle? A vehicle is the type of securitization, because we have so many types. We have CMO during the financial crisis, we have CDOs, we have the normal pass-through, we have the MBB. Now we have so many others. Today, we are only covering three of them, which is the pass-through, CMO, and MBB. Now, as we move in the lecture, I will start with the pass-through, then I will go to the CMO, then I will go to the mortgage-backed bonds, which is a different arrangement for both of them. Let's start with the pass-through. So the pass-through, which is actually the normal, it's the mother of these securities, which is this process is actually a normal pass-through. So as I told you here, this is a typical pass-through. This is a typical pass-through. You pass it from here to here, and this guy passes it from here to here. So this is a normal pass-through. And so I give an example. Assuming a bank originates 100, say today public bank originates 100 or 1,000 loans, okay? New fixed rate residential mortgage loans. Now, average size per mortgage is 300,000, which means the pool now, which we say the pool is 330 million, which is 100 loan times 330 million. Now, the average mortgage rate, which is 8%, which means those customers will pay 8% to you. This is the interest of this loan. And the capital requirements, this is one more thing. The capital requirement is when you issue those loans for 30 million, you have to have capital requirement according to Basel. It's not the 10.5%, but actually it is according to Basel requirement, the risk-weighted asset, which we will talk about it in week 11, they say you take 50%. This is the risk of it is 50%, it's not 100%. So actually, don't worry about this calculation. It just takes 30 million times 50% according to Basel times the 10.5 capital. So I need actually this type of capital. Now, this is, as I told you, the risk-weighted asset was given according to Basel tables. Now, assume the bank holds 5%. In this country, it's 4%, but assume it's 5% of the value of the loan portfolio, which is the Federal Reserve. So we are talking about 1.5 million, another 1.5 million we need. Okay, so actually the total fund required for us now as a bank to issue those loans is, which we have to raise it from demand deposits, is 30 million plus 1.5 million, the reserve, minus the capital, my contribution of the capital. That means I need to raise a liability of 29,925,000. So issues to raise this money is one, a liquidity. If I issue those bonds, if I issue those loans, I may have a problem with the liquidity. I don't have enough liquidity inside the bank. I may have it now, but maybe I reserve it for some other things. I can use it for a few days or whatever. until I receive from the special purpose vehicle, who will receive from the investors. So this is a liquidity problem. Now, the large positive duration gap, which we already talked about it when we talked about securitization, as I told you, when we have risk-sensitive asset minus risk-sensitive liabilities, and this is actually, say, plus, and I know the interest rate is going up. If I is going up, then in this case, if interest rate, excuse me, going down, then this is not a good position, and I need to clear it. And this is what I told you when we say the interest rate at the securitization and loan sales help and controlling the gap. This is the situation. So they may have this one, and they may have also what we call the third one, which is the large large regulatory burden, because you have, when you have all those assets, you have to have large reserves, and in the same times, you have to have capital. You don't want all of these things. Solution, go securitization. And when you securitize, you would securitize the housing loans or the car loans or any loans that have homogeneity or same characteristics. So we call it homogeneity of assets. Okay, having said that, let's go to the how the pass-through works. Now I want to tell you something. This is the payment problem. Actually, to do this issue is not a big deal. The problem is for the special purpose vehicle is the prepayments. And the prepayments happen when there is refinancing. What do we mean by refinancing? Means if the interest rate was high, when I take the loans, say 8% or 10%, and the interest rate today, like in Malaysia, it's 4% or 3% sometimes, housing loan is 4%. Now, in this case, you may decide to refinance your loan and settle it down, refinance it, pay it, and take a new loan with the new rate. And this is a normal thing. They do it in so many, and if this is happening, that's fine. So what's the problem? The problem is the payments themselves will decrease. Yes, I will receive now the present value, but I will not receive it with interest. I will settle with the present value. The problem is to settling this will decrease one payment from this area, which means this guy may be gone. Now, if it's gone, which means it was 500, if this was 500, now it's only 499. What if this guy also go settle? What if all this guys settle? I mean, we keep decreasing here. Maybe when we decrease this, for example, then in this case, the payments here is less, and the payments for the coupon is less. It's a problem. Now, it's actually looks like a defaulting from the side of the special purpose vehicle. Now, therefore, this is one of the biggest problem, which is the prepayment issue. Now, to do the prepayment issue, see, people always move houses, which is housing turnover is okay if it is just some buyer come and buy the same house. For example, like when we do in the car loans, when they sell those cars in loans, you come and you take the car. There was a buyer. He will offer you after 3 years or 2 years of his car. So you come and take the car and assume the loan and pay the loans. No problem for the bank. The bank will not feel this because the payment, whether they pay it X or Y or Z, it's no problem. So this is not an issue. The transfer of mortgages is actually has no effect on mortgage pool. And this is actually when the interest rate is stable. It's just I was living in Kuala Lumpur and I decided to go and retire in Penang, or I want to find a job, a good job in Penang, and I want to go and stay there. I don't want to rent my house here and then go and rent house there or make it empty here. I'll just sell this house and I will decide to live the rest of my life in that place. So I go and settle there. So I need to settle the house in Kuala Lumpur. Either I come and settle with the bank, or it's what we call assumable mortgages. Assumable mortgages means somebody will come and take my house. I'll find the buyer. I told him, okay, I settle with him and the payments, and he continues with the payments. The bank will not. Housing turnover decision to move houses is not a big deal. The big deal is because what we call it assumable mortgages, it has no impact. But the prepayment is the problem. Now the prepayment is actually, it will affect of lower current mortgages, interest rates. This is what's happening. As I told you, the loan was an 8%, 10%. Now it's maybe there is, very slow, sluggish economy, and people, the interest rate is very low. The government is even decreasing more, so to stimulate the economy. And I'm taking those loans when there was actually an inflation and high interest rate. They maybe stable and a high interest rate in that time. So in this case, I have, say, I take it in 10%, now it's in 4%, I need to settle. So this is good. It's okay because it will increase the present value of cash flow streams. But that amount will come and then will decrease, and then no more payment of that. It's actually faster prepayments, as you can see here. It's faster prepayments. It's fewer interest, but it will be fewer interest rates because no more interest rates coming. It will increase the present value, fine, because I will get the present value of the loan. And then it will be faster repayments, as I said, but lower interest rates in the future. And cash flows can be only reinvested at lower rates. Because now if the rate is 4% and they want to give another loan, I will give it in 4%. See, it's not a good thing. Now, the good news is, I mean, there is a good news, a bad news. This is how the things is happening. The good news, based on that, the lower market yield increases present value of cash flows. Now, when the interest rate is low, it will increase the cash flow, the present value, as we see, which means the bonds now prices actually will go up because the interest rate is going down. The negative news, it will be fewer interest payment, as I said. The good news also, principal is received sooner, as I said here. And the bad news, reinvestment is a lower rate. So if you try to disseminate or analyze this issue, it can be converted to good news and bad news. The good news is lower market yields increases present value, and the principal is received today. The bad news is there will be fewer interest payments, and then when I invest this money, it will be at a lower rate. Which means now the most important thing is to forecast the right yield, the right interest rate, so it doesn't change when I issue my bonds. The other thing is I need to model the yield, which means I need to see what is the right yield to use for my issue or for the bonds from the special purpose vehicle. And the other things, I want to see how much prepayments. If the prepayments is around 10%, then fine. I will issue only bonds for 90% of the loans. If I can really forecast how many prepayments, and I discovered that according to my distributions, about 10% to 15%, that may have prepayments. And when we do that, it's a big process, you know. You have to study the pattern of prepayments, the economy, so many things. It's a big model. If I can reach to that issue, then I say, okay, this is most possibly to be prepaid. So in this case, I will not securitize it, which means I will not pass it to the investors. I will maybe return it back to the bank, or possibly return it to the bank and take the 90%. Now, this is actually one of the difficult issues, and you have to go to econometrics, statistics. Banks do it. Banks have all those expertise to do it. So financial institution makes, this is how they do it actually, just theoretically, makes own estimates of monthly prepayment pattern, which means estimates how much, even if the people, even after, first, I need to see how much prepayments will be. And then if there is those prepayments, I can decrease the pool. And in the same thing, also, I need to study even the people existing, how many of them may go to these prepayments again. So financial institutions made also the fair price for yield. So when they price the loan, they price it correctly. Financial institutions made prepayments when they issue the loans and when they issue their bonds. The loans and the bonds also, they have to have the right yield. Okay, financial institution estimates prepayment function, which is based on those information. There must be conditional prepayment rates are modeled as a function of important economic variables. So conditional means like a sensitivity analysis. You know what would happen to the prepayments under different types or a different status of the economy. You know, booming, depression, you know, sluggish economy, and the interest rates actually change, inflation, you know. So all of those issues, you model it. And then model should also account for idiosyncrasies. Idiosyncrasies means the situation of the borrowers, which means the employment, which means the if you are giving, for example, housings, or we are going, you have to understand that this is actually, you have to study the payment characteristics of the borrowers, the individual borrowers. Okay, based on frequency distribution, and this is what we say, the distribution, a financial institution can actually calculate expected cash flows and estimate the fair yield, which is our purpose here and purpose here. So we study the pattern of the customers and we study the patterns of the economy. Okay. Now, this is actually a translation to this mind map. I'm trying to help you, you know, map your thinking around this graph, but actually, if you look at this slide, it's just saying the same thing. So housing turnover is a decision to move homes. Assumable mortgages does not necessarily affect. Transferable mortgages, no effect, okay. Now, the pass-through, in Australia, most mortgages are fully amortized. See, this is the formula actually. And my interest, as I told you here, is to calculate this payment. Now, when the Australian bank do it, they do it like amortization table. So the whole security will be formulated an amortization table where they show you the principal. Is just like as a loan. They make you the principal, the interest, the payments, the part of the payments that goes to the interest, the part of the payments that goes to the principal, and the balance at the end. So it's like this one. I have to follow up this for you. So this is what we mean by the amortization table. This is actually a pass-through security. If I have a pass-through security here of 30 years, paying monthly, which means I will have how many payments? From 1 to 360. So this amortization table will be 360 rows. Okay, each payment, this is the pool, 100 million. Now, you have to calculate column 1, column 2, column 3, column, Excel can do it for you very, very fast. I mean, but just to tell you with the function of Excel, it's a very basic thing. However, if I want to calculate the fixed monthly payments, I have to use this formula and calculate the payments. Because I have the pool. The pool, I have it 30 million. The pool, I have it 30 million. I know the R. I know this is 12. I know this is 360. I know the R, which is 10%. Then I can just calculate, and I know this is 100 million. So if I can calculate it, as you can see here, if I calculate it, this is the 100 million. This is the formula, 100 million. Then it's 12% up to 3 times 12, which is 360. Then this payment, so I find it to be 1,028,610, which means those payments, which I will pay to the bondholders, to the investors for the next 360 360 periods, which is 360 months. So this will continue for 360. Okay. Now look at the first payment. The first month when we make this amortization, it's 100 million. The payment is 1,286. If I want to break it down to interest payment and principal payment, the interest is just, when you want to calculate the interest, is just the principal times 12% over 12. This is the monthly payment. So how much is the principal here? The principal here is, as you can see, is 100 million, right? Oh, it's already there. So it's 100 million, right? So the monthly payment is actually 1 million. So I put the 1 million here, and then I decrease it from the total payment. The rest goes to the principal, which means those borrowers, when they pay me 128,610, part of it is the interest, which is 1 million, and part of it for the principal. Now, to get how much is the principal of this pass-through security end of month 1, I just decrease this one, the 100 million, which is column 1, from the 28,610, and this is the difference. Then I take this difference and I put it here, which is the principal of remaining at the end of the year is the beginning of the year, and we continue like this. Now we want to calculate the fixed monthly payment. You do the same, and this is a normal amortization table. This is how we do the pass-through. Now, coming back to the issue of this one, we talked about refinancing. We talked about all those issues, and it's actually, and this slide, refinancing. What does it mean in case of decreasing effects of lower? I already explained it in that chat. Okay, and so you can continue with this. One more thing is why the refinancing is happening when the interest rates goes down. This is how they find it. So if this is the prepayment function, the prepayment functions will be very high here and will continue to go down, down, down. If Y is actually the current mortgage rate and R is the original mortgage rate. If R is higher than, which is the original mortgage rate, 10%, is higher than the current rate, is 4, which is, for example, 6%. Now we will find it here. So this will be minus, when the difference between the two is -4, for example, See how much the payments here. And then it continued to until they are zero. There's still some prepayments, maybe because of moving the houses or settling the houses. And this is 2%. And it continued down when the Y is higher than the R. So the Y is the current mortgage. When it is higher than the original mortgage, which means I was giving 4%, and the rates now is 10%, I will not settle because of financing. There will be no financing, only for people who want to move their houses, but none because of the change in the interest rate. The main purpose of the prepayments is the changes of the interest rate for the loans. This is the whole issue. So I want you to understand this graph. The other thing is we talked about the good news and the bad news. We already talked about it here. This is when there is a payment. What would be the good news? Lower market yield, as I told you. Principal receipts owners, fewer interest payments in total, and reinvestment will be a low rate. This is the empirical model, which I already talked about it in this chart, which is those issues which I explain it. It's the same wording. It's the same wording, nothing more. Now, we are finished with the pass-through. So we said we have 3, right? This is our 3-1, the pass-through. Now I will go to the collateralized, which is part 2. It's a same pass-through, but it's a little bit different. Now the CMO, as you can see, this formula, the price of the CMO, because the CMO, you will divide them. You will make this financial engineering as we did for the CDOs during the financial crisis. And you started to break the investors. Special purpose vehicle are smart. And instead of finding one class of investors, they will find so many classes of investors, and they will sell them the same bond, the same, what we call asset-backed securities with different rates. And how can they do that? They take the advantage of the liquidity preferences of all those classes of investors. I am a bank or mutual fund. A bank, I want to invest for 1 year. So in this case, they will give me 2%, 3%. But there is an insurance company who can wait for until the end of the loans of this pool, which is 20 years. I can give them 8%. So in this case, if you add the 8% and the so mutual fund maybe take 5 years. So if I take all of those classes, add them up, the rate will be less than the pass-through. This is the whole concept of the CMO, which means the rate will be less in total if you take the average rate of those 3 classes after you divide those investors or buyers according to their liquidity preferences. If you add them up, then it will be less than the fixed rate that you are giving to everyone. So this is the, which means now the price of the CMO is higher because the rate is less. The rate in average is less, which means the price is higher when I sell them. And this is higher than the mortgage-backed securities, which is the pass-through, a normal pass-through. Okay, so this could be, MBS could be just normal pass-through security. Okay. So having said that, let me go to the calculation. Oh, we want to go to there. Look, don't just try to be scared of this. It's nothing. It's easy thing. Remember this mind mapping. It just explains. Look, in the when we add value means we want to decrease the when we add value for what? For the special purpose vehicles, because they are the one who come with this innovation and classify the investors. So the bank, they already settled with them. They just want to make more profit. So what they will do is actually, they will divide the investors to two classes. I told you. How many classes? Usually we have tranche A, we call it tranche now. Tranche B, tranche C, or class A, class B, class C, class Z, and class R. Now, who is, all of them will receive coupon. Class A, who are they? They are shortest. They need a short life securities. Look, during the financial crisis, when we used the CDO, the preferences was the credit risk. So high quality, less credit risk, more credit risk. This one, they are the same credit risk, but the preferences is the liquidity. People want their money faster. Some people can, some investors can be a little patient up to 5 years, like mutual funds. Bank need it in a year or less. When you go to pension funds, which is retirement insurance companies, they are not worried. They can wait for 20 years, but then they will receive all those people will receive different rates. So the shorter the prepayments, now the less is the return I give you. So this is minimum prepayment protection. Potential, I don't have to use prepayments for those people. Potential buyers, savings bank. No, the buyers is banks and commercial banks and retail banks here. Now, class B is the same thing, expected, 5 years, something like 5 years. There is an average prepayment function, which means we expect a prepayment for this people. This we didn't expect a minimum actually. And those people is actually, who are they? Superannuation funds, this is the retirement money, or the insurance companies, as I told you. The class C is longer average life, and this is maximum prepayment function, which means we expect a lot of people to make prepayment during the life because it's a long term. And potential buyers also, those guys the same. They buy short term and long term, which is superannuation funds, insurance companies. Only the banks are here. Banks they cannot hold money. They cannot invest for a long time. Okay, so we have also another class, which is accrual class. Accrual class is payments happen to these people after I finish those, like preference shares and equities. When we liquidate a company, we pay the bondholders and then we pay the equities. These people serve like them. So after I settle all those classes, and they know, I will settle Z, which is accrual class. Payments only occurs after I pay all those classes. Now, it's a stated coupon and has characteristics of zero coupon bonds. Now, these people, I don't pay them a payment, I just pay them at the end. So the settlement with them, when we issue them the bonds, it's a zero coupon, which means we will pay them in maturity. Now we have class R. This is just the tail, after we settle with all these people, after we settle with A, B, C, and finish them, Z, we settle with this. So owners has right to residual collateral only after we settle all those ones. This is the whole thing of the CMO, which means actually the secret is to break. You can continue breaking. And this is very, very smart work if you can understand the preferences of liquidity for the current investors and offer them those backed, asset-backed securities. It's a great job. You can actually decrease the rate of the loans of the pass-through. So we have mortgage protection prepayments for A, B, and C and D. We don't have it for those people and those people, which means if nobody paid or there is pre-financing, then actually those people are not involved. They can receive less than their coupons, okay? Having said that, I just can go to the calculation. Now, assuming I have a pass-through, of 200 million. I break this path through to 3 tranches. Tranche A, tranche B, tranche C. This is 50 million, this is 100 million, this is 150 million. 50 million, 50 and 100. So this is 200 million, right? Which was a normal pass-through. Now I give this guy 7% tranche A, but he will receive all the payments. I didn't say now how long he will receive. I will tell him whatever payment come will go for you. I didn't say I will pay you in 1 year or 2 years or whatever payment is there, all the payments will go to you, plus your interest. This guy will tell him, after I finish this, for all his payments, you will receive interest. So the interest will be divided between the 3. But the principal will only be paid after I pay the principal of this one. And for tranche, sorry, I have to correct this. So this is tranche A, this is tranche B, and this is tranche C, sorry. Okay, so this is 3 tranches. Now, if we received a monthly payment of 2,500,000, 1 million of it interest payment, and 1,500,000 is payments and prepayments. Payments, which is the normal payments, and prepayments. See, all prepayments will go to the first tranche. All prepayment, all the normal payment, which is this one, this part, if I go to the schedule, all of these payments all of this is the normal payments. This will go for the first tranche until it is retired. Plus anybody who may make prepayments, who may make prepayments, which means settling. These people continuing, and this is what they have to pay through 360. But if there's some people come and settle with huge amounts, it also will go to the tranche A. So going back to here, so I received this one. This is payment and prepayments. So let me divide the 1 million first as coupons. So for tranche A, tranche B, and tranche C, 50 million, 7% over 12. This is what he get. Tranche B, 100 million. His is 8% for year. And I'm talking about monthly payments, 303,000. And then for tranche C is 375, the same calculation. So the coupon, as you can see it, it's here, it's here, it's here. What about the prepayments? Will go to this guy. So this guy will receive 291 plus the 100 million. Those people, they will receive all of them, the interest, divided according to their investment. But the principal, which they should receive in normal case, because they are going to receive more interest, I will not give it to them. I will give all the liquidity to tranche A until he finish. Now, to continue with this discussion, assuming now I am done with tranche A. Look, assuming tranche A retired after a few years. Let me just change this, please. This is tranche A. This is tranche B. I'm just using the case. Lowercase. This is tranche A. So we don't, we are working on the same page. This is tranche C. Okay, so we'll continue with this. Assuming now the old example, tranche A is retired. This guy is gone. This guy now, all his money is paid. So I left with 2. Now money is coming. Assuming now we received 1 to 8. Part of it is actually going an interest, and 500 of it principal. I know already this principal will go here. And this one, that's 7.8, I will divide it between the two of them. And I already divided 100 million times 8 over 12, 330, 50 million, it's 375. They receive. And we continue with, this is, I have to correct it. This is tranche B, sorry. And this is tranche C, okay? So now we have tranche B and tranche C. And until we finish with tranche B, then all the money will go to tranche C. And if we have, so this is actually tranche A, tranche B, and tranche C, which is class A, class B, class C. Then if we have R and Z, they will be after that. So this is the whole take of the CMO. Now, let me take, so what? I mean, I tell you, oh, there must be some savings. If I am, how a CMO achieves profit for the special purpose vehicle. If I have assumed you have a bond issued, 200 pass through, 200 million, okay? Now, 200 million pass through. Annual coupon payments is 200 million times 8.5, which is the basic rate. This is for the pass through. Now that is 70 million. Fine. Let's divide it according to those rates, 6%, 9%, and 9.5. I paid actually for this guy for the 53 million, 9 million, 4.5. Actually, I paid total of 16,750, which is less return. So the difference between actually the 70 million and all those amounts, which is 6750, is actually 250,000. I just decreased 70 million from this amount, which is this amount minus this amount, 250,000. This goes to the special purpose vehicle, not to the bank. Special purpose vehicle now are making good money, which means this is actually achieving this formula, which we are saying the payments from 1I to N, which is in this case, this is 1 to 3. Because how many classes we have? We have 3 classes, right? This is I'm just trying to use this equation. Okay, I put it in. So it's from 1 to 3. The price of this is 1 to 3, is actually more than the prices for the normal MBS or the bus through security. Okay, if I'm done with this, let's go to the third one. As I told you, we have 3, right? We have 1 pass-through, collateralized, and mortgage-backed. Let's go to the last one, which is the mortgage-backed. Now, the mortgage-backed is the same. However, the securities does not leave the balance sheet of the bank. Actually, the asset will stay there, and they will issue bonds backed by those assets, which means the balance sheet will, inflate, but the asset's still there. Which means what? Which means the bank now is working as a special purpose vehicle and the bank in the same time. He's taking the function of the special purpose vehicle. There is no independent special purpose vehicle, and he has to take care of all those things. And we call it mortgage-backed securities, or MBB. Now, MBB are bonds collateralized by pool of assets. What is the special features? They are still on the balance sheet. There is a relationship between the cash flow on underlying asset and cash flow on bond is one of the collateralization, which means when those banks issue those bonds, your claim is against the bank. It's not always, the bank will start paying the co-bonds, but it doesn't mean they are paying it exactly from the payment. They are paying from the pool of their cash. whatever it is. It's not like they have special accounts and then everything has to go to there and then you pay it. And therefore, because of that, I mean, they don't form special purpose vehicle in. It will be integrated within the bank, which means the cash that comes from everywhere, it will also settle those payments, which means there is no specific line following those payments. And therefore, investors are really worried about it. And they say, okay, if this is the situation, I don't know, you may use our cash or I mean, the thing is not clear. So now for each issue, if you are going to issue a 10 million ringgit of, or 100 million of bonds of the securities MBB, then in this case, you have to have loans of 120, which means there is, yes, it's a collateral, the loans which is backing the securities is there, but the investor also require more loans to be collateralized, which means as to back this. So we are going to issue 100 million of bonds based on the MBB, which is a pass-through, just a normal pass. It's not a pass-through. It's MBB actually. The bank is going to issue a bond. Now, then of 100 million, you have to have loans of 120 million. So MBB bondholders have first claim. If there is a problem, of course, with the bank and this is good to liquidate, they have first claim on the mortgages. They will take the mortgages and follow. It's their own, they own those mortgages. Okay. Now the problem is the illiquidity, need to over collateralization, and capital adequacy implication. Liquidity means sometimes you can be stuck. The bank can be stuck of those because the pool of the cash is not actually, you have to pay it from the bank, which means you are not selling all the yes, you received for the bonds, but there will be always a problem with liquidity, which is different from the special purpose vehicle, who only takes care of the payments and pay it. Now the payments that comes from the loan holders can be, scattered here and there, maybe in the new loans or whatever, and not paid actually to the bondholders. This I mentioned when we say to 120%, and this actually capital adequacy implication. The bonds, the loans as an asset still in the bank and their total assets. So actually your asset did not decrease, which means your capital is not decreased because the assets still inside. So you have a liquidity problem, you have over collateralization problem, and you have capital adequacy implications, which is capital is not decreased. Now this is just another what we call mind mapping for the mortgage-backed. It's just what I have said. You can look at it. I just want to make it easy for you. I make all those maps, mind mapping for all those securities. One more thing. Pass-through is differs from, the MBB is different from pass-through and CMO in two key aspects. MBB normally remains on the balance sheet, as we understand, and there is no direct relationship between the cash flow on the collateralized mortgages and the bonds, which means the money that comes from the mortgages is not specifically kept to pay the coupons of the bonds. There is no, clear direct relationship. MBB is over collateralized, as I said, and normally it stays in the balance sheet. And there is no relationship between the cash. And the MBB is over collateralized by mortgage, could be sold with higher credit rating. This is another problem because of the collateral, the credit risk is actually because of the over collateralization. Credit risk is actually less because there is safety, and because of this safety, there will be, which is a good thing actually, will be higher rating. I mean, those rating agencies will rate them higher. Okay. Now, no, they are not popular as the CMOs and CDOs, actually the most popular, this tranches thing. I am done. Is only one last slide. Securitizations, the benefits on the versus the cost. So the benefits is, as you can see, it's a new funding source. It increases liquidity, as we said. It managed the duration gap, and it reserve, which is, if you take it off, you will decrease which we talked in the beginning about it. It will decrease the capital adequacy, and it will decrease the reserves. So decrease the reserves, it decrease capital adequacy, it manage the duration gap, increase liquidity, and it's actually it's a funding source. This is a good thing. The bad thing is the cost. There is a cost when you have special purpose vehicle. You have to pay fees, you have to pay insurance, you have to pay all of those. So guarantees is the insurance, and you have to pay fees for the special purpose vehicle. Now you have to go for evaluation of the assets before they back them. A special purpose vehicle need to evaluate them to see who is allowed to be in the pool or no, according to their current price, which is the market price. Now, in this case, when they do that, there must be valuation of all those assets as of today, and then and also the cost of heterogeneity. Heterogeneity, which means that you cannot back different types of loans. So that is what you call heterogeneity. Homogeneity means you need homogeneous. There's a cost for that one. So as you can see, I'm done. And if I am done, I'll stop sharing, and I will see you in the tutorial. There will be a long tutorial for this one. Good luck. Enjoy the weekend. Bye-bye.